Hindsight bias is a cognitive distortion affecting perception of past events. It involves overestimating one's ability to have predicted an outcome after it has occurred. This bias creates a knew it all along effect. The effect distorts memory of the prior state of knowledge. Hindsight bias can negatively impact judgment and decision-making processes. It leads to an inaccurate assessment of predictability. Hindsight bias affects traders' perception of past events. It involves recalling analyses with inflated certainty after price movements. Traders may overestimate the accuracy of their initial predictions. This occurs even if the original forecast was made with uncertainty. The bias leads to a distorted view of one's trading skills. It can negatively impact future decision-making in trading scenarios. Hindsight bias is a memory distortion affecting traders' perceptions of past events. It involves reconstructing past analyses with the belief that market event signs were obvious. This reconstruction occurs even when the signs were initially ambiguous. Traders overestimate their ability to have predicted the outcome. This bias leads to an inaccurate assessment of past decision-making skills. It can foster overconfidence and poor risk management in future trades. Hindsight bias amplifies overconfidence in traders. This bias causes traders to overestimate their market skills. It also leads to an inflated sense of predictive abilities. Traders develop a false belief in market predictability. This overconfidence can result in poor decision-making and increased risk-taking. This bias negatively affects the learning process in trading environments. It leads traders to incorrectly attribute successful outcomes to their skill or foresight. In reality, these outcomes might be due to chance or luck. This misattribution prevents traders from accurately assessing their decisions. Consequently, genuine mistakes are often overlooked or not recognized. The ability to learn and improve trading strategies is therefore significantly hindered. Hindsight bias is the inclination to perceive past events as more predictable than they actually were. This bias can significantly distort memories and judgments of prior decisions. Traders may falsely believe they accurately predicted market movements, like Bitcoin's price drop after ETF approval. Such distortions can lead to overconfidence and flawed decision-making in future trading scenarios. A trader predicted that the Fed's move would cause a rally. This prediction was made despite the trader considering multiple potential scenarios beforehand. The trader's statement reflects a specific expectation regarding the market's reaction. The Fed's move is perceived as a catalyst for a market rally. The trader's confidence suggests a belief in the Fed's influence on market trends. The rally is anticipated as a direct consequence of the Fed's action. A trader experiences regret after prematurely selling a financial position. This regret stems from observing a subsequent price increase after the sale. The trader laments the missed opportunity to profit from the continued uptrend. This scenario illustrates how hindsight can influence the perception of trading decisions. Chart pattern analysis involves interpreting historical price movements to predict future trends. Traders often analyze chart patterns to identify potential breakout or breakdown points. Hindsight bias can lead to overconfidence in interpreting past chart patterns. Traders may falsely believe a pattern's outcome was predictable, ignoring prior uncertainty. This bias can negatively impact future analysis by creating an illusion of certainty. Hindsight bias negatively impacts risk management by distorting perceptions of past events. This bias leads to underestimation of uncertainty when evaluating potential future risks. Traders, influenced by hindsight, may reconstruct past events with a false sense of predictability. This reconstructed certainty can cause traders to take on excessive risk, believing outcomes are more predictable than they are. Revenge trading involves traders taking on excessive risk. This behavior is driven by the desire to recover losses from perceived missed opportunities. The frustration stems from hindsight bias, causing traders to overestimate their ability to have predicted market movements. The goal is to quickly make up for these perceived failures. This often leads to irrational decisions and further financial setbacks. Hindsight bias can significantly influence trading behavior. It encourages a pattern known as strategy hopping among traders. Strategy hopping involves frequent changes in trading approaches. These changes are often based on reconstructed narratives of past market events. Traders affected by hindsight bias tend to oversimplify past events. This leads to the belief that they could have easily predicted those outcomes, prompting them to switch strategies. Hindsight bias significantly influences emotional cycles. It creates a perception of predictability regarding past events. This bias leads to frustration over perceived missed opportunities. These opportunities were, in reality, not predictable at the time. The resulting frustration negatively impacts emotional stability. Therefore, hindsight bias can trigger and intensify emotional fluctuations. Traders can mitigate hindsight bias by using a trading journal. The journal should record analysis conducted before each trade. Predictions about the trade's outcome should be noted. Confidence levels regarding the prediction should also be documented. A trading journal should document alternative scenarios considered before a trade. This documentation provides a record of pre-trade analysis. Alternative scenarios include potential outcomes that were anticipated. Recording these scenarios offers insights into the trader's thought process. It also allows for review and learning from different possible market reactions. Comprehensive scenario planning enhances trading strategy and risk management. The blind review process emphasizes evaluating trading decisions independently of their outcomes. Traders should initially review their trading journals without knowing the results of each trade. This approach helps to eliminate outcome bias from the evaluation. The primary focus should be on the quality of the decision-making process itself. Analyze the rationale, strategy, and risk management employed in each trade. This method provides a more objective assessment of trading skills and identifies areas for improvement. Probabilistic thinking involves framing predictions as probabilities rather than certainties. Traders should quantify the likelihood of different outcomes. For example, express expectations as a 60% chance of success instead of a definite outcome. This approach acknowledges inherent uncertainty and allows for better risk management. Before initiating trades, traders should conduct a pre-mortem analysis. This involves proactively identifying potential failure scenarios. The core question to address is, what could make this go wrong? Traders should systematically brainstorm and document possible risks. This documentation serves as a reference for risk mitigation strategies. Pre-mortems enhance decision-making by anticipating adverse outcomes. Blind trade reviews involve evaluating trading decisions without knowledge of their outcomes. The primary goal is to assess the quality of the decision-making process itself. This method removes biases introduced by knowing whether a trade was ultimately profitable or not. Outcome data is intentionally concealed from the reviewers during the evaluation. This allows for a more objective assessment of the trader's strategy and risk management. Focus shifts to factors like rationale, adherence to rules, and risk-reward considerations. Traders should meticulously record their predictions before each trade. This record should include the rationale and expected outcome of the trade. After the trade, compare the actual outcome with the initial prediction. Systematically analyze these comparisons to identify any recurring biases. Objective tracking of prediction accuracy helps refine trading strategies. Traders must acknowledge the inherent unpredictability of financial markets. Accepting uncertainty is crucial for making rational trading decisions. Acknowledge that positive trading decisions may not always yield favorable results. Conversely, suboptimal decisions can sometimes lead to unexpected gains. Successful traders recognize that outcomes do not define the quality of a decision. A profitable trade does not automatically indicate a sound decision-making process. Conversely, A losing trade doesn't necessarily mean the initial decision was flawed. Decision quality should be evaluated based on the information available at the time and the reasoning applied. Focusing on decision quality promotes consistent, rational trading strategies, independent of individual trade results. The primary objective is to maintain a consistent process. Success is defined by adherence to a disciplined approach. It is not about being correct in every single action or decision. Focus should be on the method rather than isolated outcomes. A disciplined approach fosters predictability and control. This consistent process ultimately leads to long-term success. Financial markets are inherently unpredictable, regardless of retrospective analysis. Hindsight bias often creates a false sense of predictability. This bias leads to an illusion of control over market outcomes. In reality, markets are subject to numerous uncontrollable factors. Therefore, perceived control based on past events is often misleading. Hindsight bias can distort perceptions of past events. A rigorous process is essential to counteract hindsight bias. Meticulous record-keeping provides an objective account of events. Detailed records help to avoid the trap of, "I knew it all along." Humility is crucial in acknowledging the limits of foresight. Recognize that not everything can be predicted in advance.